Modern financial culture is obsessed with the upper layer of wealth. It's a world defined by venture capital, disruptive apps, and loud branding, an economy that relies on constant visibility and explosive, often volatile, growth. Beneath that noise sits a physical economy operating in total silence. This is the lower layer. It is comprised of the mundane infrastructure society takes for granted, the gravel parking lots, the septic pumping routes, and the coin-operated laundromats that function regardless of what the tech sector is doing. Acquiring these unglamorous physical assets is a practice known as micro-private equity. Instead of chasing unicorns, you are looking for established businesses that solve small, repetitive problems for a local community. The competitive advantage here is a deliberate lack of public interest. Because no one is writing magazine articles about parking lot striping, the assets remain affordable, stable, and tucked away from the frenzy of traditional markets. This entire economy functions on a small, repeatable unit. Consider a single, used vending machine placed in the waiting room of a 24-hour tire shop. The arithmetic is primitive, 100 transactions a day. Subtract wholesale costs and electrical draw, leaving 75 cents profit per drop. Costing under $1,000, this unit produces $200 monthly cash flow, a high-yield proof of concept for the entire system. While you were sleeping or sitting in traffic or watching television, a physical asset solved a micro-problem for strangers and converted their daily friction into your equity. Scaling this concept requires moving from micro-vending to macro necessities, using a decades-old coin laundromat as a template for larger acquisitions. These legacy businesses often have chaotic handwritten ledgers. To a university-trained accountant, a notebook filled with ballpoint ink and scratched-out figures looks like a disaster. Water usage provides the forensic truth. Cross-referencing utility bills with washing machine specs reveals the exact loads processed and true net cash flow. This is the Tuesday morning market. People require clean clothes regardless of interest rate hikes or stock market corrections. These basic human requirements do not negotiate with recessions. They provide an unmoving anchor point in the physical world, allowing you to replicate the model across dozens of locations. Generating significant capital creates a new pressure, the urge to display that success. You may see a tech founder driving a matte gray luxury SUV and wearing designer labels to signal status. In contrast, the stealth wealth operator drives a 5-year-old Honda with a minor scrape on the bumper and keeps a low profile. Looking wealthy is an expensive operational burden. High visibility invites tax audits, lawsuits, inflated vendor pricing, and endless unsolicited pitches. An ordinary appearance functions as physical armor. It allows you to move through the world without generating friction, keeping you unburdened by social performance while the system runs in the background. This discipline also applies to growth. When a skilled associate asks for $75,000 to expand their service business, the amateur instinct is to write the check, but capital is only fuel. If you put fuel into a broken engine, you don't get a faster car. You just get a bigger explosion. Most struggling businesses have internal leaks. This shop loses thousands to unbilled labor, chemical overcharges, and a toxic escalating lease. By patching these 3 leaks, cash flow increases 30% without a single new customer or new debt. Building these systems provides operational independence. Once the engine is efficient, capital can finally be used as fuel to replicate the model across the region. 12 years after that first vending machine, you are back in the hardware store on a Thursday afternoon. You are buying industrial drain cleaner for a backed-up utility sink at one of your laundromats. Your phone vibrates with a quarterly summary. This is the result of a multi-decade roll-up. Thousands of individual, unsexy assets, land leases, parking lots, and service routes, aggregated into a single holding company. The net portfolio balance is $650 million. You check the figure for 3 seconds, then slide the phone back into your pocket. You have a sink to fix, and no one in the store has any reason to look your way. Reaching this scale feels identical to collecting that first $190 from the tire shop. The process was always about the quiet accumulation of physical equity, not the number on the screen. The architecture of uninteresting wealth yields a silent system that secures the only asset that ever mattered, your own time and your absolute independence.